In this video, I will be explaining everything you need to know about 401ks. I'll cover the basics of these retirement accounts, explain how they work, compare and contrast traditional with Roth, and leave you with a strong understanding of how all this works. This video is designed to be comprehensive, so whether you are completely new to this part of personal finance or already have a retirement account set up, you should learn something from this video. All of the sections in this video are timestamped and have links in the description below if you want to skip ahead to a specific topic. In the United States, a 401k plan is an employer-sponsored, defined contribution personal pension account. The concept of the account is defined in subsection 401k of the U.S. Internal Revenue Code and is how the account gets its name. Let's break down the terms from the definition. Employer-sponsored means just that. All 401ks are sponsored by your employer. You cannot have a 401k without your employer offering one. If you wanted a retirement account not tied to an employer, that would be an IRA, which is briefly discussed in a later section of this video. Defined contribution is one of the two classifications of retirement plans, the other being defined benefit. Defined contribution plans are plans where the account holder and potentially employer contribute a predefined amount to the plan, and nothing is specified about the benefit amount. Defined benefit is the opposite. A predefined benefit amount is set to be paid out of the plan once the account holder reaches retirement. An example of this would be a traditional company pension or Social Security. Lastly, personal pension refers to the fact that this is a retirement pension account. Pension, derived from the Latin word for payment, is simply a retirement payment to the account holder. In America, pension is often used as shorthand for a company-paid defined benefit pension, wherein a company agrees to pay a retiree a fixed amount for the duration of their retirement should they fulfill certain service hour requirements. These pensions used to be commonplace decades ago, but have now largely been replaced by 401ks. For the duration of this video, to avoid any confusion, I will use the term pension to refer to the shorthand of a company-paid defined benefit pension, and retirement account to refer to retirement accounts of all types. Lastly, there are three stakeholders in a 401k: the participant, you; the sponsor, the company offering the 401k, your employer; and the record keeper, an institution where the funds are actually held/invested. For most of the 20th century, Americans retired on company pensions. The concept was simple. Someone would get a job with a respectable company in their 20s, work diligently for 30 years, and retire after completing their required years of service to get their pension payments from the company. This defined benefit pension plan was an agreement between the employer and employee to defer some current compensation in exchange for future compensation. The employee would work for a slightly lower nominal salary for the 30 years, with the promise that the company would support the worker in old age. One thing to note is that these benefits were a function of a formula, not a function of investment returns. Say, for example, your employer offers $100 a month in retirement per year of service worked, and someone works for 26 years at a company. They would then be entitled to a pension payment of $2,600 per month. Defined benefit pensions are expensive, and companies don't last forever. Even those that last a long time are often bad at planning for the long term. These basic facts contributed to the decline of employer pensions and the rise of the 401k. The history and decline of pensions is its own 30-minute video, and whether or not defined benefit is better or worse than defined contribution is outside the scope of this video. What's important to note is that the burden has shifted from the company to the individual. Companies will often contribute to modern 401k plans, but those contributions are almost always a match to employee-given contributions, and the success of the retirement account is on the individual to get investment returns, not the company to pay fixed amounts in perpetuity. The 401k, at its core, is an alternative to the company pension that shifts the risk from the company to the individual. Pensions do still exist, however, and you in fact participate in one. It's called Social Security. Social Security and other national social pensions, like those in most of Europe, are state-administered, defined benefit pensions. Governments use taxes to raise funds for the pensions, then pay out to retirees a set amount upon hitting the national retirement age. Each country's system is different, but the U.S. Social Security system benefit amount is based on how much money a taxpayer puts in during their working lifetime. The more money paid in, the larger the benefit amount. So, if the government already runs a defined benefit pension, you ask, why does someone need a 401k at all? While there are many problems with Social Security, the simple fact is Social Security doesn't pay out enough for the average person. Living in America is expensive, and the average monthly payout of around $1,550 is often not enough for people to live on for the rest of their lives. Lower income earners are especially at a disadvantage since you get a larger monthly payout if you pay more in. Even with a fully paid off house, imagine trying to live off the equivalent of $9 an hour for the rest of your life. So, you now know the basic concept of a 401k and why you need one for your retirement. But how does a 401k actually work? What is an employer match? And how much should you contribute? In a 401k, you, the participant, contributes money from each paycheck into the account, and your employer will, in most cases, match up to a certain percentage. Say, for example, your company offers a 401k with a 100% employer match up to 3%. This means that for every dollar you contribute, your employer will match that contribution up to 3% of your salary. Matches can be tiered as well. Your employer could offer a plan where they match 100% of contributions up to 3% of your salary, then 50% match for the next 2% of your salary up to 5%. To max out your match in this scenario, you would need to contribute 5% of your salary into the plan to get an effective full employer match of 4%. In general, maxing out your employer match is a good rule of thumb when deciding on contribution amounts. If your employer offers a 100% match up to 4%, might as well contribute that 4%. Because every dollar you invest will be matched. Some companies even contribute to your 401k regardless of individual contribution amount. It's important to understand your 401k plan's matching when determining how much to invest. As to what percentage you should actually invest, there's no one-size-fits-all answer. Financial advice always depends on the circumstance, and even the highest level, most general advice has caveats and exceptions. In general, it is advised by most financial advisors and personal finance professionals to at least get the full match out of your 401k, i.e., if your employer matches 4%, you should at least try to get the full match. It's also never bad to invest more money for retirement, whether that's in a 401k, an IRA, or even an individual brokerage is up for discussion. But in general, the more money you invest, the better. There's an asymmetry to risk here if you really think about it. You definitely don't want to invest too little for retirement lest you end up with not enough money later in life. There's much more downside risk there to investing too little than there is risk on investing too much. So in general, default to saving more. Employer-contributed funds are not immediately your money, however. They are subject to vesting. Over some set period of time, called a vesting schedule, your employer contributions will become vested, meaning those dollars are actually yours. If you were to leave the company or withdraw funds prior to those funds getting vested, all unvested employer contributions are void and returned to the employer. The vesting schedule is determined by the sponsor company based on years of service and can vary. I'll briefly run through 3 common vesting schedules. Example 1 is a cliff vesting schedule. In this schedule, all funds vest at once after a set years of service requirement, in this case 3 years. Once an employee hits the 3-year mark, all employer funds, regardless of contribution date, are now vested and belong to the individual participant. Example 2 is a graded vesting schedule. In this example, a certain percentage of funds vest each year up to 100%. This case is what's known as a 2 to 6 grade. The vesting starts at 0% after 1 year of service and increments by 20% each year after until all funds are fully vested by year 6. The name 2 to 6 derives from the fact that 1 year of service still means 0% vested, so the effective vesting really begins after year 2. Example 3 is a fully vested schedule. This generous employer immediately vests all contributions from day 1. A note: all participant contributions, i.e. the money you put in yourself, is always yours and never subject to any sort of vesting. Vesting only applies to employer contributions. There are 2 types of enrollments for 401ks. Traditionally, 401k plans are opt-in, meaning an employee must choose to opt in or participate in the 401k plan. Employees may do this either during onboarding at a new job or during a company's open enrollment period each year when benefit choices are allowed to be changed. The other enrollment type is opt-out plans, also known as automatic enrollment. With opt-out plans, employers are allowed to automatically enroll their employees in the company 401k plan as the default, requiring employees to deliberately opt out if they don't want to participate. Companies with opt-out plans select a default investment fund and savings rate, but the employee may change the savings rate and investment choice at any time, or even lower their rate to 0%, effectively opting out should they so choose. Opt-out 401ks are designed to encourage higher participation rates among employees in the plan. Employers can also choose to increment participants' default contribution rate, encouraging them to save more money as time goes by. Your employer could have a default savings rate of 3%, but have that rate automatically increase 1% each year of service to some maximum contribution rate. This offers employees who don't feel comfortable managing their own 401k a decent default setting. The default investment fund is usually a low-risk, balanced index fund at a low savings rate of around 3 to 4% with automatic yearly increases. While not usually optimal choices, these defaults are better than saving nothing. At the end of the day, however, employees do have control over their 401k enrollment and contribution choices. If you were auto-enrolled at a rate you didn't like, or a fund that doesn't fit your investment goals, you can simply change them before the next paycheck. There is a set maximum amount you can contribute to your 401k each year. The limits are set by the federal government and adjusted each year for inflation. The 2023 limit is $22,500 if you are under 50 years of age. Anyone over 50 is allowed to contribute a higher amount. This is called a catch-up contribution, with the idea being that some people over 50 who are closer to retirement may not have enough saved up, and therefore a higher contribution amount is afforded to them. The catch-up contribution adjustment for 2023 is $7,500, which brings the total contribution amount for an individual over 50 up to $30,000. Note that these contribution limits are individual contribution limits, and your employer match contributions are not counted against this sum. If you max out your 401k personal contribution at $22,500 for fiscal year 2023 and have an employer match, you will have more than $22,500 in total contributions for that year. Links to contribution limit resources from the IRS are in the description below. Another note, since there are no government-mandated contribution limit percents against paychecks, and most plans do not restrict a participant's contribution percentage either, some people will temporarily increase their contributions towards the end of the year to hit their maximum. Some people may save, say, 4% of their salary all year, but come November, they increase this to 40% in order to load as much money as possible into their 401k before the end of the year. Another key feature of a 401k, aside from the employer match, is the tax benefits. 401ks offer one of two types of tax advantages to participants. Traditional 401ks are pre-tax earnings and offer the tax benefit of deferred taxation. Traditional 401ks are pre-tax in that contributions are made to the account before income tax is calculated. If you contribute $1,000 even, the full $1,000 appears in your 401k with no income taxes taken out. This means that you have a larger pile of money to invest since no tax is assessed, and that your overall income tax liability is reduced. If you make, say, $50,000 a year in salary and contribute $5,000 to a traditional 401k, your taxable compensation for that year is $45,000. This is the benefit of deferred taxation. You are deferring your tax liability for later, while reducing it now. This money isn't tax-free, however, and you will eventually have to pay income tax on it. This occurs when you withdraw the funds. Money you save during your working years is taxed upon withdrawal during your retirement years in a traditional 401k. Roth is an alternative to traditional 401ks that offers the opposite taxation structure of a traditional 401k. Roth 401k contributions are post-tax earnings, and qualified distributions can be made tax-free. The funds contributed to a Roth 401k are subject to income taxes and will be less than the nominal amount selected by the participant, since the participant's current tax rate is assessed. The upside is that withdrawals can be made tax-free, effectively affording Roth 401ks the unique benefit of growing investments without being subject to income taxes. A participant may contribute a smaller nominal amount to a Roth 401k, but none of the money in that Roth, principal or growth, is taxable upon withdrawal. So, which should you pick, traditional or Roth? It depends, and I cannot give you a definitive answer. I will, however, offer some very high-level general advice. Traditional offers the clear-cut benefit of reducing one's tax liability now. If you are a high-income earner paying lots of income tax but plan to withdraw much less money in retirement, i.e., you will have a lower tax rate, an argument can be made that this person should prefer a traditional to lower their tax liability now while it's high and deferring it for later when they are subject to lower taxes. Alternatively, someone who is in their 20s with an entry-level job not paying much in income tax may prefer a Roth, so they pay lower taxes on the money invested now. Then, when they have a large pile of money in their 60s, can withdraw it tax-free as opposed to the much higher tax rates they would otherwise be subject to. These examples are just the tax rate arbitrage lens of looking at this. Which one to choose can vary based on a number of circumstances, but know that neither choice is the wrong choice. The only wrong choice is not saving anything for your retirement. Consult a financial advisor or tax professional if you are uncertain about which plan is best for your circumstances and goals. All of the funds in your 401k are locked away until you hit the age of 59 and a half. Why they didn't choose 60, I could not tell you. There are technically two ways to withdraw before 59 and a half. First is just pulling the money out early. Withdrawing funds from a 401k early will compel you to pay a penalty fee of 10% on top of all due taxes. This fee results in the amount of money you receive being far less than if you had never invested in a 401k at all and instead just put your money into a brokerage account with no tax advantage. Do not withdraw funds directly from your 401k if you can avoid it at all costs. There are a few exemptions to this early withdrawal penalty defined by the IRS as hardship. Hardships such as, quote, funeral and burial expenses and, quote, repairs to damage of the participant's principal residence are subject to conditions and restrictions. I've linked IRS resources for hardship withdrawals in the description below. If you do need access to the money in your 401k for some reason and your plan supports the provision, you can take out a 401k loan. A 401k loan is a loan taken against the balance of your 401k. It is not taxable income and does not receive the 10% early withdrawal penalty as long as the loan is paid back in accordance with the loan terms and complies with Section 72P of the IRS Internal Revenue Code. The interest on the loan is also not paid to the loaning institution, but rather back to the plan itself as essentially after-tax contributions. A 401k loan term may not be longer than 5 years, except for the purchase of a primary residence. A reasonable rate of interest must be charged, and payments must be made at least once per quarter over the life of the loan. Plans may make these terms more restrictive, however. Defaulting on a 401k loan is just not a good idea. The entire balance of the loan and interest owed become classified as taxable early distribution to the participant and subject to income taxes in the year of the default and the 10% early withdrawal penalty. Do not default on a 401k loan and do not take one out if you think you will have trouble paying it back. While you may begin to withdraw money from your 401k at age 59 and a half, you must begin withdrawing before age 70 and a half. This feature is called Required Minimum Distributions, or RMDs. Upon April 1st of the calendar year after turning 70 and a half, you must begin withdrawing a certain amount each year or be subject to a massive 50% penalty of the amount that should have been distributed. RMD amounts are a little complex, calculated based on age, life expectancy, spousal age, and tax filing status. I've linked IRS resources to RMDs in the description below. Additionally, if you have RMD questions, your plan sponsor contact should be able to assist. So, you hit age 60 and decide now is the time to start withdrawing some of the money you've saved up all these years. How much should you withdraw? In the ideal circumstances, you would only withdraw from the interest/growth and never touch the principal amount. Even better is to only withdraw some of the interest/growth each year and let the rest reinvest to continue growing the pot of money in the 401k as the cost of living rises each year. Imagine a simple scenario where person A has exactly $300,000 in their 401k, and they make a fixed 8% per year return on this principal, netting them growth of $24,000 per year. They elect to withdraw half of the yearly growth, 4%, or $12,000 that year. This is called the 4% rule and is generally advised that you withdraw around half of your interest/growth each year and reinvest the other half back in to grow the pot further and hedge against inflation. Following this example, the next year, person A now has $312,000 in principal and earns 8%, or $24,960. They again elect to withdraw half the growth and get $12,480 this next year. Again, everyone's circumstances are different, and in emergencies, withdrawing a large sum from the principal may be the best course of action. In general, choosing to leave the principal untouched and only withdrawing the interest/growth is a solid default strategy. What you want to avoid is a situation where you have $100,000 in your 401k and have to take out $12,000 a year to cover living expenses. After little more than a decade, all the money in the 401k will be gone. Since a 401k is tied to a specific employer, you may be wondering what happens when you change companies. In most cases, you as the participant will want to roll over your 401k. This rollover can go to one of two places, either your new company's 401k or a personal IRA. A rollover is simply a consolidation that moves funds. Either is a valid option, and these rollovers are generally tax-free, meaning you won't have any tax consequences or withdrawal penalties for moving your funds from one company's 401k to another. A 401k is an investment vehicle, and the funds contained within may be invested in funds, shares, or products that the plan offers. Each 401k is different, and the investment options available are determined by your sponsoring company. Most 401k plans, especially at larger companies, tend to offer a standardized set of investment products such as S&P 500 index funds, several varieties of target date retirement funds, funds that balance stocks and bonds and shift gradually more towards bonds as you age, and fixed income/bond funds. Be very careful to read the prospectuses of any funds you are considering investing in. High fees are the enemy of investments, and you want to be diligent as to avoid exorbitant fees on investment products offered in your company's 401k. As to what funds you should invest in, that I cannot answer. Each person's financial goals and life circumstances are different, and I can only lightly touch on the broadest possible high-level investment good practices. In general, you want your money to grow as large as possible because who wouldn't want more money? If you are younger and have more time for investments to compound, then 1, congratulations on starting so early, and 2, in general, you can afford riskier and higher returning investments. Someone in their 20s is safer off investing 100% of their funds into, say, stocks, which offer higher returns but do have more associated risk. Whereas someone aged 65 should think a lot more about investment risk and may find lower risk, lower return investments like bonds more suitable for their circumstances. If you don't know what investments are right for you, consider learning as much as you can about general retail investing principles, and you might become comfortable enough to manage your own financial decisions. Personal finance is one of the keystone concepts to learn in our modern lives, and knowing the foundations will set you way ahead of the crowd. If investments and finance truly isn't your thing, however, consider speaking with a fiduciary quality financial advisor who can tailor advice to your specific circumstances. In addition to fund fees, 401k providers, that is, the actual institution that manages the 401k plan, usually an investment firm, will charge fees for the administrative and maintenance costs associated with the plan. These fees may be charged to the employer, the participants, or the plan itself. There are, unfortunately, 401k plans with very high fees, and small companies are especially vulnerable. Check the plan fees and investment fees on any potential 401k, and if you find the fees to be upwards of 2% or more per year, these fees could have an outsized effect on your financial security. Imagine you can only afford to contribute 3% to a 401k and your employer matches another 3%. However, this particular plan charges a 1.25% administration fee annually against participants, and the cheapest index funds available also charge another 0.75% annually. You would be losing a vast sum of your yearly savings just to fees alone. If your company does not offer a 401k or offers a low quality one, i.e., one with a poor employer match, high fees, or both, you might want to consider opening an IRA instead. An IRA, or individual retirement account, is like a 401k in that IRAs are tax-advantaged investment vehicles designed for people to contribute their own earnings towards retirement. IRAs are a whole other topic, and as such, are a dedicated video, currently in the works. If you want to see a similar long-form explanatory video on IRAs in the future, consider subscribing so you can catch it when it comes out. And that concludes the basics of 401ks. We've covered all the foundational concepts of 401ks so you can understand how they work, why they are important, and how they can help you achieve long-term financial security. I left out smaller topics such as HCEs and top-heavy balancing, as they aren't as relevant to the core understanding of 401ks for beginners. In the description below, I've linked a bunch of resources for 401ks for both general and specific concepts broached in this video. If you found this video helpful and enjoy this style of long-form content, consider hitting the like button and subscribing for more of this type of content. The comprehensive guide to IRAs video is in production now. If you're subscribed and have notifications on, you'll be alerted when that video releases. Thanks for watching.